It is no secret that the market moves on trade headlines these days. So tonight we asked our market monitor for a list of stocks that should be able to weather the trade war. Trip Miller is with us tonight. He's founder and managing partner at Gullane Capital Partners. Trip, thanks for joining us tonight.
Thanks for having me, Bill.
And I have to say, I'm scratching my head a little bit on your first pick. That would be FedEx. If there's a vulnerable company or a company vulnerable to the trade war, that's FedEx. And it has been reflected in the stock price the last year or so. Why do you like this one?
I agree with you. As long-term value investors, we've been long-term shareholders in FedEx, and we've certainly felt the pain in the short run, at least over the last year. But we think this is a wonderful buying opportunity at roughly 11 times forward earnings. We're optimistic that something will happen with a trade deal at some point before the election, and FedEx will benefit from that, as well as benefiting from integrating their TNT acquisition from a few years ago, and optimizing the utilization of their ground network in the U.S. To benefit the growing e-commerce business. So we think FedEx has a lot of upside potential, and we think they've been doing the right thing buying back stock.
Number two, Dollar General, certainly more domestically focused. And boy, this chart, and we're showing 5 years. If you went back the 10 years that this company's been trading, it's a thing of beauty, as they say. But as it sits here near all-time highs, you still think there's more growth?
We do. We think it's a recession-resistant business, and we also think that it's one that, with the trade war going on right now, has not been impacted as much as their competitor, Dollar Tree Family Dollar. And so when we look at this business going forward, we like the fact that they're buying back roughly $1 billion in stock per year. They pay a small dividend, and they can grow their store count significantly over the coming years. We believe they can grow anywhere between 600 and 1,000 stores per year for the next 7 years.
And finally, this is also a bit of a head-scratcher for me. First Solar, this industry has suffered for a number of years. Yes, there's competition from overseas, especially from China right now. But here's a stock that has been sideways for 7 years. It's almost like dead money, and it doesn't even pay a dividend. Why do you like it?
We were buying into it earlier in the year when the stock price was much lower, and we continue to like it in here. We think that they benefit from the fact that the trade war is benefiting them by hurting their Chinese competitors that have tried to saturate the U.S. market for many years with panels. First Solar is really the only competitor left that's domestic in the space, and we think that going forward, utility-scale solar makes a lot of sense. It's roughly on parity with the other energy sources out there. So we think that there's a lot of upside here, and we like the fact that Lucas Walton, Sam Walton's grandson, owns 20% of the stock.
Okay. Some sponsorship there you like as well. Some interesting stock picks tonight. Trip Miller with Gullane Capital Partners. Thanks again for joining us.
Thank you.